short-term capital gain. First, take the full value of sale consideration. From the sale consideration, deduct selling expenses like brokerage or any other transfer expenses. The balance is net consideration. From the net consideration, we should deduct the cost of acquisition and the cost of improvement. The balance will be short-term capital gain. Securities transaction tax cannot be claimed as deduction. If there is any short-term capital loss, then such loss can be set off against short-term capital gain and long-term capital gain. Let us now look at the calculation of long-term capital gain. So as usual, take the full value of sale consideration of the capital asset. From the sale consideration, deduct selling expenses. The balance is net consideration. From the net consideration, we are going to deduct indexed cost of acquisition and indexed cost of improvement, and the balance is long-term capital gain. In case of long-term capital loss, such loss can be set off only against long-term capital gain. And securities transaction tax cannot be allowed as deduction. And for the following assets, there is no need to index. They are number 1, bonds or debentures. Number 2, equity shares in a company or a unit of an equity-oriented fund or a unit of a business trust referred in section 112A. Cost of acquisition. Any amount spent by the assessee to acquire the asset is the cost of acquisition, and if the asset is acquired by way of gift or will, in this case, the cost of acquisition is cost of the asset to the previous owner. For purchase of goodwill or trademarks from others, the cost of acquisition will be the purchase price. Bonus shares acquired after 1/4/2001, the cost of acquisition is nil. If the bonus shares are acquired before 1/4/2001, then the cost of acquisition is equal to fair market value on 1/4/2001. In case of rights issue, cost of acquisition for rights issue is equal to amount actually paid for such rights issue. If an asset other than depreciable asset is acquired before 1/4/2001, then the cost of acquisition will be the cost beneficial to the assessee. Usually, the actual cost of acquisition or fair market value on 1/4/2001, whichever is more, will be the cost of acquisition. If the asset other than depreciable asset is acquired before 1/4/2001. Cost of improvement. Any additional capital expenditure incurred in making additions or alterations to a capital asset is called capital expenditure. It may be by adding a veranda or an extra bedroom or bathroom, etc. And cost of improvement made before 1/4/2001 is nil. It should not be considered while calculating capital gains. Cost of improvement made on or after 1/4/2001 should be considered and deducted while calculating capital gains. In case of long-term capital gains, cost of improvement and cost of acquisition must be indexed. So first is index cost of acquisition. So cost of acquisition adjusted according to price level changes is called indexed cost of acquisition. And the formula for calculating index cost of acquisition is equal to cost of acquisition into cost inflation index for the year of sale divided by cost inflation index for the year of acquisition. And if the asset is acquired before 1/4/2001, then cost inflation index for the year 2001 to 2002 must be taken. Next is indexed cost of improvement. Indexed cost of improvement is equal to cost of improvement into cost inflation index for the year of sale divided by cost inflation index for the year of improvement, that is during the year in which improvement has taken place. CII is cost inflation index, and cost inflation index from the financial year 2001-2002 to the previous year will be given in all the income tax textbooks. And in case of index cost of improvement, if the cost of improvement takes place before 1/4/2001, then such cost of improvement should not be taken for calculating capital gains.